We're analyzing Essex Property Trust, stock ticker ESS, to see if its market price is a fair value. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Essex Property Trust. Then, we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Essex Property Trust for your portfolio. Before we get into these valuable metrics, let's understand Essex Property Trust stock performance. Essex currently trades for $207.94 per share. In the last year, their stock price is down 40%. This is more than double the decline in the S&P 500 during this time. In the last 5 years, Essex is down 13% overall. In the last 10 years, their stock price is up 2.5% compounded annually. That's a return of about 30%. Going back prior to the global financial crisis, Essex is compounding at a rate of 6% annually. Their stock price has more than doubled in the last 18 years. Essex Property Trust is a real estate investment trust, or a REIT, meaning they pay a significant portion of their earnings as dividends. Essex Property pays a large 4.3% dividend yield currently. Their average dividend yield throughout this time would be in addition to their compounded annual returns. Essex trades $10 above their 52-week low. The company has been cut by $150 from their 52-week high. 2% of their shares are sold short. The company has a $13.5 billion market cap. But why should we be paying attention to Essex? Essex Property Trust owns a portfolio of 252 apartment communities with over 62,000 units. The company focuses on owning large, high-quality properties on the West Coast in the urban and suburban markets of Southern California, Northern California, and Seattle. The company has an additional 6 properties in active development. Starting with metric number 1, we want their average return on equity in the last 5 years to be above 12%. The typical REIT earns about a 6% return on equity, so looking for a benchmark that's double this allows us to build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Essex has increased their returns on equity throughout this time. In all 5 of these years, they were above average returns on equity. When we average this out, Essex earns about a 7.7% average return on equity in a given year. That's a couple percentage points above a typical REIT, but that's below our benchmark, meaning this is an X on metric number 1. Metric number 2, we're looking at the growth of the business. We want to see cash from operations and revenue growth in the last 5 years. This metric will only be a check if both of these are up. In this time, Essex has grown their revenues by about 10%, and their cash from operations have grown by about 18%. The company did see some of this decline in 2020 as the locations where their properties are located were hit hard, especially as residents were leaving some of those areas, but the company has recovered and they're above the levels that they were at in 2018 or 2019. With both of these being up, this is our first check of the day here on metric number 2. Metric number 3, we're looking for decreasing shares outstanding in the last 5 years. Many REITs tend to be externally funded. They rely on issuing shares or adding debt in order to fuel their growth. We want to be very mindful for excessive shareholder dilution, especially shareholder dilution that wouldn't be value accretive. That doesn't seem to be the case here for Essex, as they've actually repurchased shares in the last 5 years. They've marginally bought back about 1.5% of their shares outstanding, which is somewhat atypical for a REIT, but it's likely a strong sign to see in the business. That's why we're looking for it, and that's why this is a check on metric number 3. Metric number 4, we're looking for cash flow per share growth in the last 5 years. This puts together some of our previous metrics where we were looking at their cash from operations and their shares outstanding. Because they've grown their cash from operations and they've decreased their shares outstanding, this has led to strong cash flow per share growth for Essex. This is another check here on metric number 4. So far, through our first 4 metrics, we have 3 checks and 1 X for Essex Property Trust. During economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. In metric number 5, we're evaluating how the business uses debt. We want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of cash from operations that Essex has produced in their last 5 years. Essex ended their most recent fiscal year with about $6 billion in net debt, and in their last 5 years, the company has produced about $4.4 billion of cash from operations. This is coming in below the amount of debt that they're using in the business. This is an X on metric number 5. This may or may not be a potential concern here. Depending on the types of assets that a REIT owns, they may be able to take on more debt than some other types of assets in different businesses. This really depends and it varies REIT to REIT and business to business. With Essex primarily owning apartment properties, it may not be unreasonable that they would have these higher debt loads. This is something that you would want to dig into their filings and understand how their debt is structured in more detail. The big metric of them all, metric number 6, we want their average cash from operations to their total enterprise value to give us a yield that's above 5%. If this is the case, this will provide a slight risk premium to the yield of the 10-year treasury, and it may offer a starting point for a fair value of Essex. Essex Property Trust has a $19.6 billion total enterprise value. This takes into account both their market cap and their net debt position. We learned in the last 5 years the company produced $4.4 billion in cash from operations, meaning they produce slightly under $900 million of cash from operations in a typical year. When we divide that by their $19.6 billion total enterprise value, that gives us a 4.5% average cash from operations to enterprise value yield for Essex Property Trust. On a current basis, the company produced $976 million in cash from operations in their most recent fiscal year. When we divide that by their total enterprise value, that gives us a 4.9% current cash from operations to enterprise value yield for Essex. Both of these are coming in higher than the yield of the 10-year treasury. However, they're down slightly from that risk premium we'd be seeking. This is an X here on metric number 6. Just because this is the case doesn't mean that you toss out this business. This is not financial advice. It's not a buy or sell recommendation of any security. You'll want to stick around as we perform our discounted cash flow analysis to come to a more concrete estimate of their fair value before we give a final rating to the business. But first, we can't forget about our bonus metric. As our bonus, we're looking at Essex dividend profile. Essex pays a large 4.3% dividend yield currently. However, people make mistakes all the time by blindly chasing dividends, so we want to see that their dividend is supported. Essex has supported their dividends with their cash flows in all of the past 5 years. They've grown their cash flows per share over this time. They've also increased their dividend per share payouts over this time as well, and they've maintained a reasonable payout ratio between the two. Even though this is a snapshot of their last 5 years of performance and it's no guarantee for the future, Essex dividend seems to be healthy and it seems like it's sustained by their cash flows. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Essex Property Trust, which brings us on to using a discounted cash flow model to come to an estimate of their fair value. A discounted cash flow model is based off the predictability of a company's free cash flows. It's just like any model in any discipline, its outputs will be sensitive to its inputs. Here we're starting with an average of their cash flows in their last 3 years, then we're using historical growth assumptions to project these into the future. It's up to you to do your own homework to understand whether these growth assumptions will be accurate and applicable going forward for Essex Trust, starting with the 3-year average of their free cash flows and growing these at a rate of 5% annually for the next 10 years, then assuming that they grow at a rate of 4% annually for the 10 years from there, adding in their tangible book value, which gives us an estimate of their net worth. If we were seeking a 15% rate of return, which is the rate of return Warren Buffett is looking for in addition to his margin of safety requirements, it looks like at today's valuations of Essex Property Trust that an estimate of their fair value is around $194 per share. That's only $13 below their current stock price. There are some factors to be mindful of. Essex Property Trust has been a moderately predictable business in its past. That's not a guarantee for the future of the company. Their dividend yield would be included in this rate of return. We would not be doubly counting their dividends. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Before considering any potential investment decision, please consult with your financial advisor. In just a minute, we'll talk about our final rating for Essex Property Trust, but we have to address something first. What are the qualitative aspects of the business? Starting with the qualitative factors supporting a potential long thesis. Number 1, supply growth should be kept in check as rising construction costs and tighter lending standards should reduce the number of projects that are started. Number 2, Essex's high quality assets should see relatively consistent long-term demand from high-income earners and will likely see just a small hit to fundamentals as most residents have not experienced job losses. Number 3, Essex's portfolio benefits from strong job and income growth and limited supply growth in its attractive West Coast markets. Then for the qualitative factors supporting supporting a potential short thesis. Number 1, the company's concentration in the tech-focused markets of San Francisco and Seattle leave the company exposed to the possibility of falling fundamentals if the tech industry goes through a downturn. Number 2, with short leases and a competitive housing market, demand for apartments can be more volatile than many other commercial property types. Number 3, the pandemic has made millennials consider alternatives to urban apartments, including suburban apartments and single-family home ownership. This demographic has put off many major adult milestones, but may finally be making the shift toward the suburbs. That's a balanced perspective of the qualitative aspects of the business. Now it's time for our final summary. In analyzing Essex Property Trust, stock ticker ESS, we learned the business earns slightly above average returns on equity. They've grown their revenues and their cash from operations in the last 5 years. The company has bought back some of their shares, and they're growing strongly on a per-share basis. They have more debt than what we'd ideally want compared to their cash flows. That may or may not be a potential concern. On both an average and a current basis of their cash from operations to their enterprise value yield, those were coming in above the yield of the 10-year treasury, but below the risk premium we were seeking. Essex has grown their dividends in each of the last 5 years. They've consecutively increased their dividends for 29 years in a row, and they've supported these dividends with strong cash flows in all of the last 5 years. Performing a discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions, from today's valuations of Essex, if you are seeking a 15% rate of return, an estimate of their fair intrinsic value is around $194 per share. That's only $1 below their 52-week lows. It's worth reiterating this is not a buy or sell recommendation of any security. It's not financial advice. Before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. With all of the factors of our analysis in mind, it looks like Essex Property Trust is a strong candidate for further research. This could be an interesting business to dig into. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, comment down below what business you want me to take a look at next. Thanks for learning about Essex Property Trust with me, and have a great day.